Our next speaker is Daniel Gilmour. Daniel's a farm economist based at DPI in Warrnambool. He's part of the team that delivers the farm monitor programs for the livestock and dairy industries. Prior to this, Daniel worked as a beef extension officer, delivering beef check, practical beef marketing and cost of production workshops to beef producers across northern Victoria. Daniel and his wife live on their family farm in southwest Victoria, producing steers for the feedlot market. So I guess he's one of those delivering extension who actually does practice, hopefully, what he preaches. Daniel.
Thanks very much for that. Contributing to the farm. Yeah, don't ask the old man about that. Possibly not as much as he'd like. I just like to say thanks for having me along today. It's very nice to be back north of the Divide. I did my first placement after uni up here for 8 months and worked out at the Rutherglen DPI site. So it's really nice to be back under some clear blue skies in the winter. It was 6 degrees and blowing a gale and raining when I drove through Ballarat on the way here yesterday. So thanks for having me up here. I'd like to thank David for his talk. I don't quite know what I'm going to talk about for the next 40 minutes, David, because you've covered just about everything I've got. So I might try and drill down to the farm level about what drives profit. David skipped over that a little bit, but I might try and go into a little bit more detail, and I'm going to use some of the results from our Southwest Farm Monitor project that's been running for about 40 years. Now, my title when I got my letter to ask to speak was Fundamentals of Being a Top 20% Producer, and I thought, geez, that's a bit of a mouthful. So I'm just going to call it Show Me the Profit. And when I'm going to talk about Show Me the Profit, I'm going to talk about the profit that you get being a top 20% producer. So I want to talk about why you want to be a top 20% producer, how you measure whether or not you are a top 20% producer, again, talking about those things that matter and those things that don't. And I want to talk a bit about defining farm performance, and then we'll go into a bit more detail about what some of those top farming producers do. All right, so over the last 15 years, the top 20% of producers in the Livestock or Southwest Farm Monitor project have earned rates of return from operating double what the average has been able to do. And that's double of our project, and we think that's above the industry average. So what does that actually mean? So for the average, the average return on asset, which is a whole farm measure of how efficiently you're using your assets to create wealth, was 3.4, and for the top 20% you can see there it was 7.2. It was over double, and it was a similar story with return on equity. And the other interesting thing to note about that is that when you look at the return on asset and the return on equity figure, you'll see that in the average, the return on equity figures actually decline compared to the return on asset figure. So that means that people are borrowing money, but they're not being able to generate returns to make that money work for itself, where the people in the top 20% are able to borrow money at a lower rate than they're able to make it earn. So a clever person is a person who borrows at 6% to get a return of 7.5%. So what does that actual double rate of return look like? Well, the number of years it would take you to double your wealth from operating, if you are in the average, it would take you 25 years to double your wealth. If you're in the top 20%, it will take you less than 10. And what does that mean? If you start with $1 million, in 25 years, you'll have 2 million. And the worst thing is, because of the rate of inflation, your 2 million bucks won't even be worth what your 1 million bucks was today. So you need to be faster than that. But if you're in the top 20%, that 1 million bucks will now be 6 million bucks. And so you'll be able to really drive some performance and expand your enterprise. When I said the returns that we're seeing here, the average from the ABARES, who do the great backward-looking stuff, is about 1% over the last decade. So you can see here that we've got some farms who are what we're calling the average, who are already above average, and then we've got some really elite producers who are really pushing things along and earning great returns. And so if we look at 7.5% as the top 20% return on equity, that's the money that they're making. When we add that to another thing, before I look at that, this is just the variability from operating. So as David said, we see tremendous variability from our operating returns over the past few years. Have some really high highs, up around 12%, and then even in those low years, down here, you'll see that the people are still making money, and you can see how badly the 02-03 drought affected southwest Victoria, which was not at all. Similar story with return on equity, but here you start to see where people who are in the average here started to erode their own equity, and that's when you have those run of bad years, and we've seen that in the last decade, once you get into a run of bad years and you have sustained losses, that's when you start to make those terminal decisions that David talked about. We've seen the same sorts of things where people have responded slowly or responded the wrong way when their businesses were under pressure, and as a result, they're starting to march out backwards. Now, the other thing that David talked about was capital gains. Now, this is 20 years of land prices in southwest Victoria. Now, we're not quite running at the 6 or 8%, but we're running at about 3 to 4% over the last 20 years. Now, when you add that 3 or 4% onto 7%, you're starting to talk about 11% returns. So this is real land price. I can see people squinting. I do apologise, sorry, some of your slides, all your slides are there, some of them are a little bit out of order in your notes because I did some fine-tuning last night. But this is about $3,000 a hectare, and up here we're around $6,000 a hectare. And certainly we've seen land prices in the southwest come back over the last sort of 12 months or so, and those downward pressures that we're really seeing are starting to bear. But as with all things, land, they're not making any more of it, and so it doesn't seem that the prices will go down for a long-term future. But once we start to add those capital gains onto the returns that the top 20% are getting from operating, we're starting to look at returns well in excess of 10%. And that's a return that you can match only in the very best places in the market. And in terms of what David said about farming being a low-risk business, for those people who know how to manage their farms well, then yes, they have got a comparative advantage, and they are going to make really good money compared to anywhere else in the market that they can invest their money. So just before I go on, I want to talk about defining farm performance, because there's a lot of different things. You talk about the things that don't matter. What do we look at when we define farm performance? And the first thing I've got up there is cash flow. And if you go and talk to your banks, that's the thing they'll want to know about. What's your cash flow? But then there's all these other things that people get hung up on. And level of tax is something that some people might talk about, and you talk about that sale price and your ability to influence that. Well, we always pick up the paper and you do see whoever's topped the sale, they always make it. But what does that actually tell us about farm performance? Other things, cost of production is another one that gets a lot of a look. And then we see a lot of these technical ratios, so stocking rate, production per head, DSE, all these sorts of things. So what are the really key things to note if your farm is performing well? Now, there's three main ways that we look at farm performance analysis. And these are profit, wealth and cash. And looking at only one of those in isolation leaves you exposed to having another part of your business fall over. So you can have a really terrific return on asset, but if you're highly leveraged and you've got high borrowing costs, then your return on asset, or your return on equity, can be quite sick. And similarly, if you want high cash flow, just sell all your stock in 1 year. Your cash flow will be fantastic. Your wealth will go through the floor because you've spent it all. It's all gone, so it's not coming back. So when you're talking about how is my business performing, having a look at these three things, profit, wealth and cash, are absolutely critical. And these are the things that matter. These are the first things that I look at when I'm looking at how a business is going. This is where I start. And I look at that because it tells me what's happening on the whole farm. So what makes a top 20% farm tick? Or what are the key characteristics? So I want to have a look now at some of the things that we've pulled out from the South West Farm Monitor project about what are the differences between the average and the top 20%. The first thing I'm going to look at, this is enterprise gross margin. And so with the blue bars you can see we've got the average, and the red bars we've got the top 20%. So similarly, and I've got to stop saying, just following on from what David said, but enterprise doesn't matter. Just be good at what you do. We've got fantastic wool producers, we've got fantastic lamb producers, and we've got fantastic beef producers. And now I've pulled out the breeding only section of the beef, because certainly in that top 20% we do see a lot of trading enterprises. And you talk about having flex in the system, we see a lot of our really good farmers will have a core of breeding stock or something like that, and then they will have this flex in their system as trade steers or trade cattle or something like that, and they'll flex that number in and out. 1 year they might have 100, the next year they might have 400, and the next year they might have none. But that enables them to get some really super returns. So I just wanted to pull that out and say it's not all about trading. People with breeding enterprises can make just as much money as a good wool producer or a good lamb producer if you're a good beef producer. And swapping from one system to another isn't going to solve all your problems. Instead, find something you're passionate about, find something you're good at, find something that you've got a comparative advantage at, and really make it sing, and that'll be better than trying to chop and change or thinking that another enterprise is going to solve all your problems. So you've all seen one of these before. This is a horrendogram, and I do apologise. Now, don't get too hung up on the detail, but what I would like you to focus on is we've got enterprise costs here. So these are your variable costs along the bottom. So you can see that there's no doubt that these have increased over the last few years. Now, we've got the average and the top 20%. They always sit next to each other. And then following that, we've got our overhead costs in the yellow and then our owner-operator allowance. As opposed to looking at this along, I'd just like you to look at the pairs. And what you'll see is that in most cases, the costs incurred by the average and the top 20% of producers on a per hectare basis aren't actually that different. But it's how they've managed those costs and where they put them that is making a huge difference. And you can see when you get here to the operating profit, so the blue dots are gross income and the green lines are your operating profit, these people in the top 20% are able to manage their costs, so they keep that low cost base and they keep that low cost of production, but they absolutely smash production and they just drive it and drive it and drive it. And that enables them to get really strong returns on a per hectare basis. They've driven down their cost per unit. Their price received is probably about the same, and I'll come to that in a bit more detail in a second. But they're really able to drive, David talked about that, productivity, inputs to outputs, really able to drive that strongly. So I'd say to you that we know it's not enterprise, it's not making a big difference, and we know it's not the level of cost, but it's the way you use them. So what about price? Now, this is 40 years of data. On the yellow line, we've got the wool price. And on the purple line, we've got return on asset. So it's not hard to see that price is having a really big influence on profit. No arguments there. But is it something that drives you from being an average producer into the top 20%? Not at all. So looking at some prices over the last few years, the difference between the average and the top 20% is only between about 5 or 10%, depending on what you're looking at. And when you look at that on a total farm effect, when we're talking about multi-millions of dollars of assets under management to generate these profits, $13,000 isn't the thing that's going to make you or break you in any one year or push you into the top 10% or 20% of producers. So it's not enterprise, it's not cost, it's not price. And the last thing I want to talk about, is what about production per head? So the same thing again. So we talk about the amount of wool you cut per head or the amount of lamb you sell per head or beef sale weight per head. So what do these things look like? Again, there's not a huge range of difference, okay? So we know all these things are having an influence, but they're not driving you or a business to move from being an average business to a business that's going to appear in the top 20%. So I've just said that. So what does matter? Now, from the Southwest Farm Monitor project, we know that the number one thing that drives profit, or the number one difference between profitable farms and non-profitable farms, is stocking rate. And we'll talk about fertiliser in a minute, but this is stocking rate in DSEs per hectare per 100 mils of rainfall. You can see early on in the last decade, things were about equal, but over time that graph has spread, continues to do so. And what you see when you get similar production per head, which I just talked about, but an increase in stocking rate, is you start to see vastly expanded production per hectare. And now it doesn't matter if you're looking at wool, where you see an increase in stocking rate, because the same translates to production per hectare. You can see there that wool, on a production per hectare basis, the top 20% are doing it, producing more. If you go to lamb, similarly, we've seen higher stocking rates across lamb than the average, and that just translates to a higher production per hectare. And so when you get to beef, it becomes most pronounced, and I think that's some of the associative effects between wool and lamb, so people are selling a bit of both. But when you look at beef, you're only selling one thing, and so when you get to stocking rate, you see that the top 20% of producers are running much higher stocking rates than the average, and that really translates to a much, much higher production per hectare. So with all this kept in mind, what's fueling all this? And here it is. This is fertiliser. And so I would say that if people are not putting on fertiliser, then I couldn't agree with David more. It's just unbelievable. But the other thing I'd also say, David, and if you'd like, I'll offer you the right of reply, is that we see grazing systems and rotational grazing versus set stocking does have an influence on your ability to drive your production per hectare. The difference between, I guess, a basic rotation and intensive rotation is less so, but certainly we would see bigger differences between rotationally grazed stock versus set stock. So, do you want to? No, keep going. All right. So look. So that's so fertiliser is absolutely critical to all this, and we certainly see that that the top 20% just continue year on year to apply more fertiliser. But when you think back to that cost graph, they're focusing their costs on where they matter. They're focusing them into fertiliser, and they're not driving up their overall cost, but they're using their money more effectively. So what does this all mean? So the profit drivers that we've seen in the South West Farm Monitor project are certainly production per hectare, which is in turn driven by stocking rate. Now, price received is a big one, and it has an influence on profitability, but once again, it's not a significant driver of top performance. We did see a little bit of a difference there, as I said, between 5 or 10%, but these things, they tend to add up to being the cream or the icing on top of the cake that the top 20% enjoy. So keep in mind that price isn't going to do it, but production per hectare will. The complementary effects between enterprises will obviously play a role in the overall profitability of the business. So this is what I was talking about. Certainly when you see things like your beef production can be used as an animal health advantage for your sheep and things like that, with some of the diseases and worms and things like that aren't transmissible. So some of these complementary effects can help to make both businesses better than any one might otherwise be on its own. And associative effects also contribute to the top 20%. What I'm talking about there is what we see when we get to these top 20% of producers, when they're driving they've got good pastures, they're pushing their stocking rate, but they're making sure that they're still on top of their nutrition and things like that. When you get on top of these sorts of things and you manage your farm a bit better, you start to see you get a few more lambs or a few more calves, you get a few less deaths, you get a slightly better reproductive performance. And so once again, the top 20%, it becomes, I guess, a bit like a self-fulfilling prophecy, where you see these people are starting to not only push the system, but the system's starting to work for them as well. But is high performance sustainable, I guess, is a question you'd ask. And David talked about long-term profitability. And so what I'd like to point out is that no, on a year-to-year basis, no, it's not. So what about if Lady Luck just deals you a shite hand one year? And so what I've done here is I've drawn out, this is the Eastern Young Cattle Indicator for about the last 5 years. And I've put boxes around 3 years, 07, 08, 09, 10, and the year we're in now, 11, 12. And I've said, imagine you're a beef producer and you sell your stock around January each year, which plenty of people do. Now, in 07, 08, if you were to have sold your stock in January, you would have got about $3.20. And the average for that entire year was about $3.28, so you would have sat in about the middle. In 2009-10, your system's the same, you're doing the same thing, you're still a good farmer, but the cattle are ready to go in January, and what do you know? The price is only $3, but the average for the year was about $3.30. And so through no fault of your own, your profitability has fallen, even though everything you've done on your farm is the same. It's just luck. But not to worry, because in this year, you sold in January again and you absolutely middled it. So keep in mind that you want to set your business up to be profitable, but it's not always going to be profitable just through the hand that fate deals you. So what you want to do is you want to set your business up to be profitable for the long term, and that's been a recurring theme. And so is that possible? Absolutely it is. So here's consistency in the top 20%. So here's 20 years of farms in the South West Farm Monitor project. Now what you've got is here the number of farms up the side and you've got the number of times that those farms appeared in the top 20%. So of 140 farms, you can see that 72 have never made it in to the top 20%. And now I should also point out that not all these farms have been in for the entire 20 years and things like that. But nevertheless, 72 farms have never been in the top 20%. And you can just see how quickly it tails away. So 27, so we're up to sort of 3/4 of the sample have only been, either never been in or they've only been in once. And the reason they might have been in once might be the reason that I showed you on the previous graph. They got lucky with a bit of marketing and the planets aligned. We look at these guys out here, 6, 7, 8, 11. 11 times out of 20 years, this farm in southwest Victoria, which is a specialist wool producer, with a bit of that flex built into the system. Trading operation that moves up and down depending on the season. 11 times he's been in the top 20%. So luck does have a hand to play, but if you set your business up so it's going to be profitable into the long run, then you can absolutely make it work. So getting to the top, and forgive me, I think I might have raced through this. This might just about be my last slide. I'd finish off by saying, look, it's not about the enterprise that you're running. So we saw that very early on. And this might be a combination of a couple of slides if people are looking for them. It's not about the enterprise. So just do what you want to do and do it well. So understand your own business and work out what system will work for you. So that's the other thing. Not only is it not about your enterprise, it's not about your system. So if you've got an autumn calving herd and you look at historical data and you see that spring calving's been more profitable in the past, that doesn't necessarily mean it will be for you. Think about what system you can get to work for you. And focus on pulling the big levers first. So we saw all these things about price, about production per head. You can go and chase all these little things along the way, but focus on pulling your biggest levers first. And we saw that from all the data we've seen, from all our experience, we know that that's stocking rate and production per hectare has been a huge driver of that. So look at your fertiliser, look at what you can do to drive that. Now I've got changes to the system should always be considered in the marginal, not average sense. And what I mean by that is that, I suppose it's a word of warning. So we produce the Southwest Farm Monitor Report and ABARES and all those sorts of things, and they all have average data. And what people can want to do is to look at that average data and say, so if that's the average, and I add one more unit of whatever, I'll get the average response. Well, that's not the case at all. And I was trying to think of a good way to explain this morning, and I thought, if I think about Don Bradman's career, over his career, the Don averaged 99.94. And so if you looked at the average response, you would have expected the Don to walk out in his last innings, make 100. But he didn't, he made a duck. So the average of your past performance is absolutely no indication to how your performance is going to be for your next innings, for lack of a better word. So don't think about everything that's happened before, think about what the marginal response is going to be. And when you're thinking about the margin, think about where you can invest your next dollar that's going to give you the maximum benefit, the maximum return. And that's one of the fundamental things, because everything's limiting, whether it's your time, your land, your money, all that sort of thing. So you've only got a finite amount of things at your disposal that you can use, a finite amount of money. So put them where you're going to get the maximum marginal return. Keep in mind that technical ratios are a means to an end, not an end in themselves. And what I see about that is I've put up a lot of graphs today about P and about stocking rate and all those sorts of things. And looking at the next point, keeping in mind the whole farm approach, don't think that because the top 20% are stocked at 18 DSEs per hectare, you have to too. Think about how you can maximise your profit, wealth and cash by getting these technical ratios right. So remember the whole farm approach, and again, aim for that long-term profitability. So you'll never eliminate the year-to-year fluctuations in profits and things like that. You can set yourself up so that you can look at consistently making money, and a low cost of production is one way to do that, but you'll still have the variability. But if your business is robust, you'll certainly have a very good year or very good farm in terms of its long-term profitability. So I think that's just about it for me. So I'd encourage people, if they'd like, to have a look on our website. We've got 20 years of farm monitor data there. We've got some figures there for North East Victoria as well. Have a look at the project email and just get in touch if you'd like to talk about any more. So thank you very much.